Hello, everybody, and welcome back. Today, my guest is Claus Born. Claus is an institutional portfolio manager in the emerging markets equity team of Franklin Templeton. And today, we want to discuss recent developments in the Asian small caps universe. Welcome, Claus.
Thank you, Thomas, and hello, everybody.
Claus, small caps are generally considered undervalued compared to larger companies. What is the situation in Asia, and what are the current arguments for an investment in Asian small caps?
Yes, that's an interesting question. We had a very strong rally in Asian small caps in 2021, but Asian small caps still continue to trade at a discount to Asian large caps. And in addition, they also have a more favorable growth outlook. So investors now can buy higher earnings growth at lower valuations in Asia small caps. I think this is a very attractive combination, especially as earnings growth remains the key driver of long-term equity returns. But there are also other arguments for Asia small caps. One very important is a higher diversification of the investment universe. The Asia small cap universe provides a higher degree of diversification than the Asia large cap universe, both in terms of sectors and countries. One example is China, which is the dominating country in Asia large cap, and it has a relatively low weight in the Asia small cap index. On the other hand, India, it is much better represented in the Asia small cap than in the Asia large cap index. And finally, an evergreen argument for investing in Asia smaller companies is less efficient markets and less availability of sell-side research than for large caps. And this enables managers with a strong local research capability to identify and to invest in investment opportunities in this segment early.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now. Inflation is back as a topic in the market, and currently we see a price explosion of commodities. Which companies in sectors in Asia can best cope with this scenario?
Yeah, this is a very important question in the current context. And I believe that companies with strong management teams will most likely be the best to cope in this environment of higher commodity prices and inflation. In the consumer space, these are companies that have built up strong brands and competitive products, which help putting through price increases to protect margins. In the technology space, these are companies that have diversified supply chains and customer bases, and which also help when they need to reflect raw material price increases. And generally, we think that companies and their management teams in many emerging markets, and this includes Asia, are much better prepared to deal with inflation than their developed market counterparts. Why that? Simply because they are more experienced and needed to deal with higher inflation environments in the not so distant past. And this has not been the case in Europe, for example.
More restrictive central bank policies and interest rate hikes are making corporate financing for smaller companies more difficult. To what extent could this become a problem, especially for smaller companies in Asia?
Yeah, interest rate hikes can become a challenge for companies that rely heavily on debt financing for their investment projects, or that need to refinance existing debt at a higher cost. This situation is not exclusive for smaller companies, but also larger ones are impacted. And these companies get debt problems when interest rates increase or growth fades. And this is not necessarily something new. This has put companies into trouble many times in the past. So when selecting stocks for our Asia smaller company strategy, we prefer companies with lower than average financial leverage. If you look at our portfolio, this is reflected in the average debt ratio, which is significantly lower than the benchmark index.
China is focusing on common prosperity. So what is behind this buzzword, and which small caps in China could benefit from this trend?
Yeah, this has been something very widely discussed in relation with China. China has been growing at extraordinary rates and successfully built up and diversified its economy over 3 decades now. But this has also resulted in high social differences, which going forward may threaten the internal stability. So therefore, the Chinese leadership has announced the Common Prosperity Goal, which aims at a more equal distribution of income within the society. In this context, it is important to stress that common prosperity does include also a growth goal, and that it still requires the Chinese economy to double by 2035. Going back to companies that may benefit here, I think it's mainly all kinds of companies exposed to discretionary spending. This can be travel, automobiles. So we have more people moving into middle class spending levels. So these are normally companies that benefit in such a context, among others.
So last year was a bumpy year for the Chinese economy and especially for the real estate sector. So the crisis still weighs heavy on the economy. To what extent are small caps in China affected by the real estate crisis?
The companies directly affected by the real estate crisis in the stock markets were generally large, and so by definition, not really part of an Asia small cap strategy. But when you look at the Asia small caps index, you will note that more than 9% is real estate, which is a significant weight. We have been underweight structurally and continue to be underweight in the real estate sector in Asian small caps. We only own one company here. It's a Vietnamese shopping mall operator. And this company obviously has completely different dynamics than the Chinese real estate sector. So why are we generally so careful in the real estate sector in small caps? It's a combination of high leverage and bad corporate governance, plus a high cyclicality that makes us shy away from exposure here. We have a very long memory of investing in emerging Asia and already experienced a lot of trouble with real estate companies at different times and in several countries. So yeah, that's not really a focus of our investment team in emerging Asia.
India and Indian stocks have seen a strong rally in recent years. Are there still investment opportunities, and what is currently the case for India?
Yeah, definitely. So India had, in fact, a very strong rally last year, surprising many market participants, and it was based mainly on strong earnings performance. So if you look at the market now, it's not easy to go bottom fishing, which doesn't mean that we don't find opportunities in India. The Indian equity market offers a very broad choice, especially in the small cap segment. Maybe you recall India is the largest equity market globally by the number of listings. It's even ahead of the New York Stock Exchange. So there is a wide choice and a liquid choice of small cap names. Also, long term, we see India as one of the most interesting markets within emerging markets. The country is large, the economy is large, it is fast growing by global and emerging markets standards, and the equity market is also very broad and active. So if you look forward among the large emerging markets globally, India will probably be the fastest growing for several years going forward. And also there's a lot of catch-up potential in India. For example, in terms of e-commerce penetration, India is about 9 years behind China, but catching up fast. So we have seen a lot of new listings in this sector, which have further broadened the choice in the Indian equity market. So on bottom line, we are really optimistic on the Indian stock market in the longer term.
So this was Claus Born, Institutional Portfolio Manager at Franklin Templeton. And thank you very much, Claus, for being with us today and sharing your views and insights.
Thank you, Thomas, and thank you all.